Hello, everyone. Welcome to this member brief. I'm Bob Crimmins, founder of Startup Haven. We'll give people a few minutes to wander in, but I just wanted to share for anyone who needs a reminder about Startup Haven. We're a peer network exclusively for venture scale founders and investors. There's about 2,300 members right now, mostly in North America, all founders and investors. And in addition to our venture fund and our accelerator, we also host a number of events and programs to support venture scale founders. This member brief is an example of that. And in this case, the objective is to provide members with a way to share their experiences. Founders and investors from every stage, every sector are a part of Startup Haven, and we try to do what we can to connect founders and investors together so that they can help out. And one of the best ways to do that is to share your experiences and what you've learned along the way. So today we're going to have two members joining us, Brent Sullivan and Nick Hughes. Brent will be talking about some of the learnings that he's had recently as he's navigated to his next startup and thinking about the challenges of discovery, discovering the right thing to do, and learnings about what can go wrong if you don't do that well. And then Nick and I are going to talk about some of the challenges of how to get fundraising right, particularly difficult market right now. But even in the best of times, it's super important to get this right. So we're going to talk about some of the challenges and some of the things that can go wrong if you don't get that right. Now, if you've got some questions, we're going to have the Q&A channel open. So drop any questions you have there, and we'll try to get to as many as we can. So at this point, without further ado, as they say, I'm going to bring up Brent, and Brent is a relatively new Startup Haven member, and we connected when I saw what he had posted about the methodology, so to speak, that he was using to figure out how do I know if I'm working on the right thing, and he's got to share some of his insights in that. Brent, as soon as I find the button.
All right, I've hit the buttons. Can everybody see and hear me?
Yes, we are live.
Okay. I love to do.
Well, I want to say, Brett.
Go ahead, Bob.
It's important to me, but to us, the royal us of Startup Haven, that you would agree to come on and spend some of your time sharing what you've learned and your ideas about this. So I just want to sincerely say thank you for doing this.
Happy to do it if I can help anybody avoid stepping on a rake. Many startup rakes. Sometimes you just have to get whacked in the face, but if I can help, then here I am.
Great. Well, so I know you have a deck, a few slides to show as you walk through this. Before that, though,
yep.
You and I talked briefly before this about the notion of discovery, and I just wanted to put a pin in that for everybody now as they listen to what you're saying about that really critical realization. That and I'll translate that for folks who know me. They know I talk about the world of ideas and how there's this massive world of great ideas, not just good but great. All the ideas, the really, really good ideas. If you stand up in a room, 1,000 people, and say, "Raise your hand if this is a good idea," 999 hands go up. And a lot of times we take that to be confirmation that, oh, this is the thing I should do. But it's not that. It's a different question to know whether or not that idea is also a good business. And it's not imprinted in fine print anywhere on that idea that this is also a good business. You have to figure that out yourself. And so I'm excited to hear your thoughts on this. You're right in the throes of it now. So please take it away.
I mean, that's a spectacular place to start because, the typical startup advice is, solve a problem that you have, scratch your own itch, all of that business. Oftentimes when you scratch your own itch, it's not a good business. And I've got tons of examples of that, but let me show you the slides. I promise I won't bore everybody with some long lecture. I've only got There's only a couple here. It's just because I love visuals. Okay, let's try this. Okay, so hopefully everybody can see Sideshow Bob there.
Yeah.
So another startup flop. Now what? So let me just give you some background. So my professional training is 10 years in portfolio management and trading, but then later on as a software engineer, working at Zillow Group, and then over the last 3 years, being a startup founder. 2021, I had a venture-backed startup. I was managing a crypto wealth manager. The market tanked. There was also no demand for this. It took me almost a year to discover that. That was painful. So there was a rake in the face. Immediately after that, I jumped into business with a partner of mine to help rescue his 10-year-old startup from the jaws of defeat, doing used car aggregation. That flopped pretty quickly. But it did take quite a while. And then more recently, I started, of course, like everyone else, an AI-powered, exam, learning app. And that flopped also pretty quickly. And flop to me means we're just not hitting the growth like that is even relevant for a sustainable bootstrap business or venture interest, even like on the periphery. So at that point, I paused. I was like, okay, something's wrong. I'm not thinking about this the right way. I'm putting my effort into the wrong thing. And customers were very hard to find. We had sales on these last two. So this was not, baloney app building heads down, writing code all day. It was, me doing, day in and day out marketing, trying to find customers and really struggling. And so, right around the end of the AI learning app, actually, Bob, when I was at Startup Poker, it might've been 8 weeks ago or something. It was the big one. There were like 4 tables or something. I remember actually, like, I was like right at the end of the AI powered learning app, and like there were 4 other ones in the room. Everybody was building these AI powered learning apps, and I was just like, oh shit, we are like, there's going to be a bloodbath here. But I digress. So the question I wanted to ask myself is like, hey, am I allocating myself as a resource into the right area? Am I fishing in the right ocean? And right around this time, this guy, Jason Cohen, puts out this blog, or a friend sends it to me. And he's like a kind of a famous founder, 4-time founder, 2 base hits, 2 unicorns. He publishes this great blog that no one reads, but it's so good. Like every one of his blog posts is great. And in this one blog post, excuse me, is there a problem? He posts this huge workflow. It's essentially a gauntlet that you can pass a startup idea through from top to bottom, and it can tell you, like, is this the right thing? Like, I mean, more or less order of magnitude, is this like even worth like, charging down? Should you put any time into this thing, or does it need to immediately be morphed? And so what I did was take that, and I just built it into a little tool because I wanted to remember the moment, kind of lick my wounds. And so what I did, let me do just my startup really quickly. And this, if I go through one example, you'll see that this has like some grains of truth to it. So here's is my startup viable calculator. And for bootstrapped and VC backable startups, here's the link and whatnot. You can play around with this tool. We're looking for a score, but don't worry about the scores. Just look for the big colors, because a big color is going to pop out of this thing. So name of startup, AI learning thing, whatever, AI powered, learning tech, whatever. This is what everybody's building nowadays, super popular. Okay, so my audience for this thing, I promise I'll go very fast through this, but it's interesting. My audience for this thing was like, is like on the order of like, I don't know. For me, because I was building it for a niche, it was actually quite small. It was only like 100,000 people. So red flags are going up for anybody watching this right away. The budget that people allocate to this thing was on the order of, hundreds of dollars. You notice all these are order of magnitudes. There's $100. How aware are they that they have this problem? How urgent and important it is for them? And this is like unquestionably urgent. Like somebody has to study for an exam. I'm going to be the exam prep provider. Like I'm going to solve a problem that they must solve. How often do they make this decision? And they switch, they're only making this decision once every couple of years. You have to take an exam, whatever. And then you move on with your life. How trusting are they? It's a relatively high trust area. if somebody has a track record of test prep success, like, any Princeton review, things like that. Trusting a new company is hard because they're like, does this even work? Competition, is your competitive, do you have any differentiation? So I was like, hey, we've got AI, right? I mean, some best in class features, right? We're the best, this is like non-negotiable. And then how enduring is this? And this is the difference between one-off purchases and, strong recurring revenue, like a system of record. But we had one-off purchase without loyalty. People want to be done with the exam and move on with their lives. Okay, so you'll notice this red. Red is not good. It's not, the Japanese stock market red is good, but that's not the case here. And we pop out this score. And here's the score, 0.0004. And we need to get to 4 for venture backable. And this seems arbitrary. I know, I totally get it, but just order of magnitude directionally, is this even correct? Like, I'm even like solving the right problem. And this took months of my life, building in this direction. It's very clear from anybody, we just went through this, my audience is too small. And if you have an audience that small, your spend has to be orders of magnitude higher to get even close to what might be a bootstrappable business. Ain't nobody paying $100,000 a year for test prep. It just doesn't make sense. Other things like this, recurring, you really have to get some strong evangelism. Finally, if I'm like turning the gears, trying to make this thing work, then finally I can start to get into the green, start to see what venture capitalists or even like a successful bootstrap business might look like. And I thought, this is interesting, right? Because it's the best proxy I've seen for VC feedback. That's the takeaway from all of this, is rather than going into a VC meeting and pitching and just being embarrassed, which was like my hard feeling, like, is there a way to just like get that feedback like digitally, like right now, like today you have an idea, run it through the calculator. Are you going to embarrass yourself? So like, let's just check all those boxes right away. Yeah. Let me pause. I'm hearing little things there.
Well, I love a couple things about this. First of all, just as you walk through like 100,000 and $100 a year, and thinking about the magnitude, generally speaking, of the scale of the scope of the opportunity, the market opportunity. That's interesting. I think, a fair number of founders give that a thought. They may not actually do the math, because the math happens not just when you say, here's how big the market is, here's how much they'll pay, but when you have to then map that to how many will pay over what amount of time, at what, what amount and what margin, and how do you grow into that, and what the cost of that sale is, or acquisition of that customer. But those quantitative things are super important. You can make a lot of things fail on paper before you end up in a VC meeting, for sure. I'm curious what your thought is, though, about the qualitative things, about trust. Competition is not unknowable, but the trust and awareness are these two things that are often overlooked.
Yep. Yeah, I mean, that's where I try to capture it here. Like, how urgent and important is the problem? And I think the only way to fully diagnose that is via discovery. You have to go talk to human beings who actually have the problem. And then you have to full on mom test them. A great book, The Mom Test, teaches you how to interview customers. And essentially you want to look at how they spend their money currently, and how much money do they spend to solve a problem currently. And if they're like, yeah, I don't pay for anything for test prep. Okay, well, don't build them a solution there, because like, if they don't want to pay for it now, why would they want to pay for it later? Maybe you're doing something really, really, really special, but we capture that later with, these indifferent and low trust products. But yeah, how urgent and important it is. Do they have budget set aside to actually solve the problem? If the answer is no, who cares? Like, don't sell them a thing if they don't have money set aside for it. You want to catch people at the bottom of the sales funnel, not when they're drifting about, not even close to the sales funnel.
Now this is germane for sure for B2B, right? Because there's a customer that you're solving a problem, use case that a business has, and they will spend money to solve problems. Consumer, a little bit different. Have you seen a model, or can you think about adaptations to this model that it would work for a company with a bunch of customers? Obviously the number of customers would be big, average ticket would be low, under $100 often. Yep. And not really, it's not about urgency, right? It's about entertainment. right? Or some other psychological need that's not quantifiable in the same way. How do you think about that?
Yeah, consumer is this like interesting beast. And the first thing is that like Jason Cohen would say, if you're tackling consumer, there better be tens of millions of them out there, because the effort that it takes to even reach them is astronomical. So like, in general, don't build a consumer business. Like just full stop, just don't do it. But if you've decided I am going to do this, then you better be looking for B2B money on the back end. Great case study here, of course, is Google, right? Google, free, amazing service up front, and it's all ads behind the scene. Facebook, it's the same thing. Twitter, maybe nowadays, is trying to monetize their consumer base. They're getting this enormous pushback for $8 a month or whatever they're charging. Consumers are like so fickle with pennies. They don't care. And so you have to figure out a different way to monetize them. So Jason Cohen's, broad strategy is just like, don't even bother with consumer. Please, just stay away from it. I'm not going to charge down that path unless I've got a great ad strategy on the other end of it. That's the first thing. And then Bob, what was the other part there I got going on? You got me on my soapbox there about consumer.
Trust and awareness. I think of it as the friction of getting customers.
Yeah.
Well, if they're not aware that they have this problem, or they're not, an awareness not just about whether or not they have this problem and they're aware of the problem, but aware of solutions and the noise that you'll have to cut through in order to make them aware of what you're doing. These things are about how much friction there will be. You might have good sized market, good average ticket, like all the things line up. But if you had all those things and awareness was a challenge and trust was a challenge, your numbers have to be, the quantitative stuff has to be super, super high to overcome the fact that you're going to have to educate your market. Like, this is we're innovating. It's so innovative. People don't even really know about how to do it yet. And they don't know how valuable we are going to be in a sea of solutions, right? With, major marketing budgets from your competitors and the incumbents to make sure that people are seeing their stuff, not your stuff. And so overcoming that friction, I think there's stages perhaps as you go through this discovery, and I actually want to hear about the actual discovery process and what you're learning. But there is this element that's often overlooked about, just because there's a bunch of people that have the problem, just because if they knew about your problem and it solved their problem, they would pay you for it. Those quantitative things, again, they're a little bit easier to figure out. And when you hear about, awareness, sure, but we're so great, like if we build it, they'll come, and who knows what the implications are. But those are, whistling past the graveyard if you think that just because it's a massive market and just because there's a ton of money spent on it, that you're going to be able to succeed. Because the threshold for it working out in the end is a combination of things, not just it has to be big enough. And so to transition too, I'm curious. Now, you've been doing a lot of discovery.
Yep.
And I want you to share with everybody some of the things that you've done, how you're doing it, and what you've learned. But especially the nuance that comes from those conversations, actual conversations, customer discovery conversations, where you learn stuff you can't learn without having that conversation. And how, it's not just how much would you pay for this, right? There's a lot of other things that you discover.
Yeah, totally. I mean, we're essentially trying to figure out like four things, like how urgent is the problem? And so an urgency is time-based. Importance is like, what's the consequence of not taking action? Like, if you do not solve this problem, like what happens? And then you have budget set aside. Do you actually have wallet for this problem? And then, the last one, urgency, importance, budget. And then I forget the last one. I'm spacing, but let me go through into like the next step here, and you'll see that this kind of makes sense. So right around the same time, if we're thinking about discovery, like the first thing that you do, you come up with your idea, and how do you start validating this thing like right away? So this another guy forwarded me Zach Weinberg's blog. One base hit, another mega exit with Flatiron Health, and he's got one that's in progress. He's used the same process over and over again. And essentially what happens is Jason Cohen says, you've got your hypothesis, like run it through the calculator, make sure this thing makes sense, like an order of magnitude type basis, order of magnitude. And then what Zach says is like, just start pitching right away. Just like start putting products in front of people and just seeing what their facial expressions are. Like, is this relevant for them? Like, do they currently have like human beings like dedicated to solving the problem? like the typical discovery type stuff. Are they spending money? How much money? How much are they spending? Is this a growth area for them? Is this like a 4 quarters from now kind of thing for them? Like, how urgent and important is this problem for them to actually solve? And then, like, if you can, like, start selling the software before it's built. Of course, like this is like the typical advice that comes from lean startup type stuff. Sell the software before it exists. And then once you've got like, this clear, repeatable story, and you've got maybe some sales like before the software even exists, that's a great time to start talking to VCs. Like, you got to do all this work beforehand and come with this package that says raising money makes sense here. It's not just I'm raising money because I need a paycheck, which, God, Bob, how many people are raising just because they're like, I need money currently? That's not relevant for VCs, for anybody listening. Like, they don't care that you need a paycheck. They care that you have a business that can scale and hopefully cover their entire portfolio. Like, that's their objective. It's not like, can I give this founder some money so they can tinker? But oftentimes I see people raising for that reason. So you want to talk about discovery. I'll tell you what I'm doing right now. So I'm in discovery. I do daily infographics. So I'm extremely active on LinkedIn, and I network relentlessly. So 1 to 5 meetings a day. I've already had 2 today before this call with industry practitioners. And what I'm doing is finding the frontiers of my industry. So I work in tax and investments. Like, this overlap is gigantic, but nobody ever talks about it except for me. And so I'm mapping the industry. I'm constantly networking, finding the frontier and finding the gaps. Where are the service providers, B2B, not consumer? Where are the service providers having challenges delivering their solutions to end customers? In my case, it's wealth managers. And you can see the kind of work that I do online. But I think what's changed for me is that writing code right now makes 0 sense, none. Like, don't even bother building anything. This is all about people. And even top tier VCs that I speak with and I give intel to are just like, you don't have to build anything. Like, we need to have like a clear story from customers that what you're building actually makes sense for their business. Like, is there a true cash flow positive business here? Or are you just gonna do the dumb engineer thing and just disappear and write code for 6 months? Like, we don't want anything to do with that. We want to see there's a clear story and that its growth trajectory is like steep. And so that's the story that you can tell behind the scenes. And if they want traction, that's like sort of a separate level of conversation. It just requires more risk on the part of the entrepreneur. But that's what I'm seeing from top tier VCs that I'm speaking with. Just tell the story, talk with a ton of people, make sure that you've got a pipeline of business. Then we will give you money to be able to close the gap between that pipeline of business and where you are now.
So important to think about it this way. The notion that your idea, the way you're coming to this idea, you came to ideas other ways, I assume. You didn't do this in the first couple, right? The way you're coming to this one is very intentional. It's very deliberate. Like, you're not building to scratch your itch. You're not building to satisfy this passion, this thing you were put on the earth to do, the thing that you discovered that is so important to you. You're working, starting at the back and working forward to, like, should I build a company? This approach, certainly for B2B, certainly if you're coming to this and you're thinking, I want to do this right. I don't want to spend, you said, would you say, like, a few months of your life can get blown away if you don't do this right. But I've seen founders that have years of their life where they didn't do this work at any point along the way. There was, I wrote this piece once about passion, how passion puts blinders on you. It makes you not want to listen to the naysayers and like, no, I'll figure it out. I'm going to, I'll get there. But in the end, the numbers don't care about your passion. You have a business sells stuff and makes a profit eventually. And no amount of, but it's my destiny is going to change that. But I'm curious, as you go through this process, like, you came to this with a very open mind. You're doing this process with a very open mind. You're not starting from, okay, I have this idea. This is the thing I want to go. You're not trying to validate an idea. You're trying to come up with an idea that you think would withstand validation. How do you think this process can be adapted for someone who isn't sitting around thinking about what my next startup should be? How should I go find that out? But they're in it. They've started. Like, they're committed. They've got a team. They've got some angel investors. But they haven't done this work. They're still not out of the woods. They don't know if they're building something that's validatable or not. How do you approach that?
I mean, you got to start talking to people today. Like as soon as possible, put the pitch deck in front of somebody, and if it makes you feel uncomfortable, great. That's exactly like the feeling that you need to experience. If you're embarrassed by your product, excellent, ship it immediately. Like you need to get the feedback. It's way more valuable than just like continuing to add feature after feature after feature, which means nothing. Like you need to get to a cash flow positive business like as soon as possible. And like part of the, the way that you do that, I did this before with a bootstrap business, I'm looking at my calendar 8 years ago or whatever. That's what this poster is for back here. But yeah, you must figure out like, you must be like a heat seeking missile, right? And the heat is where people have actual problems that need solving, not just like vanity problems where it's like temporary. They need to get this, they, things that they actually have budget to set aside to tackle. And entertainment is one of those, Bob. You asked about like Netflix and things of that sort. I think entertainment is like a budgetable problem. And the problem is boredom. Boredom is like incredibly painful, right? That's why we play on our phones all the time. And so I think that there's urgency to entertainment, but it's a separate kind of thing. But anyway, yeah, you have to be like the heat-seeking missile. You have to dive in. You have to go find where the heat is.
So your first couple, if you can just speculate, fantasize for a second, go back in time. You're 6 months into one of them, and you don't know that things aren't going to turn out well yet. You're still in the cycle where you're building, and you got customers. People are paying you money for this, so it can't be all bad. You're trying to navigate your way to it, and then you encounter this halfway through your journey, or early, but with some commitment in your journey. Imagine that you encountered this then. How? Because this strikes me as a few things. One is it's a filter to know broad strokes. Really, is this something that you should even go pursue to see if it can be a business? Like if it can't pass that test, it's unlikely to pass the other 29 tests it's going to have to pass in its lifetime. But then also as a pivot tool to tell you, if you can't fix if that's still red and you're 14 months into it, you've got to find a way out. And can you imagine this thought process being the kind of a thought process that could help a founder navigate to, similar product, different market, different product in the same market? What did they learn that they can adapt to? Is this the process that you've gone through? Can you imagine that being a good process for a founder that's already in it?
Totally. Yeah. You have to, you can take the inputs from your current business and you can say, oh, I need to charge more per head for this business to be sustainable. Oh, I need to go after a bigger market for this thing to be sustainable. Oh, one-off transactions are like, hard to sustain because of high customer acquisition costs, et cetera. So I need to switch into a recurring revenue-based model. But what this calculator does, it's only 6 inputs, is just like give you a sense of like, what tweaks can I make? How do I have to reorient my business so that I can create cash flow positivity? And I think, it's useful just to go through it. You might say, oh, this is baloney or whatever, and I've got a bunch of caveats at the bottom, but it's a great order of magnitude estimate. And if you're just like, oh, I'm so far off, like what's going on here? You can start tweaking the parameters to see what I did, just take it from red into green. And at least it can give you an idea of like the things that are wrong or troubling about your business. For me, it was like, I'm having trouble finding individual customers. And like, this was very troubling because it should have taken off like a rocket. And given the amount of effort that, my co-founder and I were putting into it, just one example, but yeah, you can use it to tweak your current understanding.
Well, I like that you use the term troubling. I've been at this for a really long time. I've seen a lot of founders do a lot of stuff. And there's no shortage of surprise in this world where somebody who you thought was doomed, it would have been all red. And then you see them, 2 years later and, oh my God, that's awesome. They turned it around. Somehow they figured it out. It's not always with the same product in the same market, and the same customer and the same pricing model and the same rest of it. But I like that you use the term troubling, because troubling it's just a signal. It's like, you should lose sleep if there's troubling things about your startup. Startups are hard when you have a tailwind. If you have a headwind, they're ridiculously hard. Yeah. So the notion that tools like this, and I do think that's one of the biggest benefits of customer discovery, is that you do get to see what the warning sign. If customers are telling, like, nobody says like, yeah, when can I buy this now? Like, you're not even doing business development. You're just trying to suss out, is this an okay idea? And if they're telling you, when can I buy it? That's a good sign. If they're telling you, no, this isn't a problem that we value, and wouldn't have any budget for this. You can still plot on and say, yeah, but that I only talked to 50 customers, and there's 500,000 customers, so I just got unlucky. Um, but that notion of the signal, and so when you do, and I'm curious your process for customer discovery and how you do it, and have you landed on, like, when I do customer discovery, here's what I do. Like, you have all these conversations. How do you run those conversations?
Oh yeah. Well, I mean, yeah, like I was saying earlier, yeah, I mean, urgency, importance, budget, and then trying to figure out like what are the problems like on their current quarter roadmap. Because I think like when I do discovery interviews, and I do a lot of them, like I get a lot of squishy signal. Folks will say, "Oh, this is great, but 2 quarters from now." That means they do not want it solved.
Yeah.
Just by the way, it's not important. So you'll get a lot of like medium signals, and don't fall into those traps. Like, by the way, like if somebody doesn't need it now, they probably don't need it, like, honestly, ever. That might be harsh, but there's always going to be something that bumps up on top of something that they can currently push away. It's very, at least I find it's very rare that you can have people switch their priorities, or maybe you can educate them. They might just be late adopters, things like that, and you can nurture the relationship over time. But in general, their current quarter priorities are like a good indication of where they're going to allocate resources. And so that's what I'm always looking for. I'll ask a prospect, like, what are you trying to solve now? Like today, what's your team working on? And sometimes they're cagey, but if they will tell you, then that's a good idea of what their priorities are, and their priorities are where they spend money. I mean, we spend money to solve problems. So
And have you
I have
found
more. Yeah.
have you found cases where you went in with, I mean, I think it's healthy to have a thesis. You shouldn't
Yep.
be, you shouldn't have a lot of conviction about it. You should be humble, like, hey, we're not sure if this is the right thing or not, but we're trying to figure it out.
Yep.
But when you get to that part where it's more of an open-ended, tell me other things, like what else are you working on? Have you made any discoveries there that made you pivot the idea, not whether or not the idea that you have would be the idea, and if you can navigate through these 4 categories of signals, but also just like, oh God, I hadn't thought about that, but now I've heard that 23 times. That could be a big, it's not the thing I'm working on. There's another problem in the space, or some way to adapt what you're working on to that new thing you didn't go in to talk about, but you learned it as part of that more open part of the discussion.
Yeah, totally. Like even this morning, I was talking to 2 guys, and both of them different conversations. Both of them were like, "Oh yeah, we're working on X," and I was like, "Well, like who's working on it?" "Oh, well, we've got some guy slated to start in 2 weeks who's going to start working on it." "Oh, okay. So you're starting to work on it. You're not sort of like waist deep in it right now." And what I discovered was that, yeah, I was going in with a new investment management product in the back of my mind, not pitching it per se, but looking for gaps in their process. And they were like, "No, no, no. Actually, we have these analytical need." And I keep hearing this analytical need over and over again. And I'm like, well, I'm not going to do the investment management product. I mean, that's a long journey, a very impacted space. But the analytical need, that's interesting. Like I can ship that now. I don't need regulatory approval. I can do it like in an Excel spreadsheet, for a little bit. I can deliver that product much quicker and much more cheaply than the investment management product. And I was like, and I keep hearing about the analytics product over and over again. So that was an immediate pivot in like the thing that I care about when I'm sussing out or when I'm doing interviews. But just by the way, like I'm 50 or so into this, and I still don't know enough. Just to give an order of magnitude to people, like 50 is not enough. 2 years ago, I would have said, oh, I had 65 discovery interviews, and my product is right. Clearly, that was wrong. And the second thing is 65 is not even enough. Like, first of all, talk to almost everyone in the industry if you can. I mean, just like the patterns will emerge, but it's so much more work than I think people initially assume.
Yeah. Well, and I think too, I bet if we catch up in a year and then in 2 years, you'll still be doing customer interviews as you evolve your product. It's not something that you do for a minute and then you're done and then you go build a startup. It's something you're doing now to land somewhere near where you think you should be. But the value of customer discovery, that's why I love that you're so passionate about this, because customer discovery, it doesn't stop. I mean, I know a founder, Series B, who still carves time out to go talk to customers, their own customers and customers they don't have, just to see what they're missing and see, like,
Yep.
of every company evolves, it grows, new products and services, new customer segments, new markets. And this customer discovery thing is so important for the whole way.
Totally. Yeah. Don't ever give up on it. I mean, it like changes shape. Like when I'm talking with like really established players, like the two guys that I spoke with today, you know, discovery goes from the founder level down into business development. And the business dev people are constantly doing discovery. But for founder led discovery, yeah, you got to do it. I mean, I'd say, way down into the series rounds. But yeah, I mean, it's priceless and it feels good. Like when you're talking to like a partner who's like, oh, I've got this problem. You're like, oh, I can solve that. Then you have like a mutual understanding. Like it's a good thing. It's not sales, it's not yucky sales as some people associate it with, particularly my like engineering friends, like, oh, sales is gross. No, it's not. Like you're helping someone else solve their problem. And like that's actually a great feeling. That's why it's motivating.
Yeah. So one last thing, I'm asking you a favor. Make me better. I talk to a lot of founders and at different stages, like you said, customer discovery takes different shapes. If it's a very new idea and you're not sure if it's a priority or what the budget is for it. Not every startup needs to do discovery around those four things that you talked about. But if you're not planning to do them or you haven't already done them and you're onto that sort of next other shape of customer discovery, then be careful because those four things you mentioned, three, you didn't say the fourth one. I bet it's just as germane as the three. But there's a pattern just to get founders to do it,
Yep.
to sort of lower the barrier and reduce the friction of them actually going and talking to customers. The formula, the recipe that I recommend to them so they'll get started is go in humble with your idea, whatever problem you think they have. You don't even know if it's a problem they have. It's a problem you think they have, and
Totally.
you want to know if it's really a problem. And you have a solution, but you're not sure it's the right solution. We're not saying like this is how we have an idea about how that problem could be solved. Is that your problem? And this is what we think would that solve it. And then there's three things that you do. You say, first of all, what do you like about this, right? And you're giving these potential customers permission to be nice to you. You don't want them to be nice to you, but I found that it helps if you just let somebody say something nice to you first, because they're nice people and they don't want to like, oh, this sucks, I'd never do this. But give them a minute, and you don't tune it out. Take notes if you want to, but it's not important. The fact that they like something, you don't need that as much as you need the next two things, which is now, thank you for that, appreciate that. Now, what don't you like? What would make you not do this? Like, what are the problems that you see that we don't see that would make this a non-starter for you? That sort of line of questioning. You gave them permission to be nice. Now you're asking them to be mean, right? So they're better set up to be mean. And then after that, it's like, okay, good. Thank you for that. That helps a lot. What are we missing and what would make this better? And that open-ended part of the end of the conversation, after they were nice to you and after you gave them permission to be mean, then that's where that discovery, but the analytics piece is really important to us, right?
There's one potential rake in the face there, and that's that if you put the solution in front of them, like I'd say they're 50% of interviews I do, they're just like, they want to be nice, like right away. Oh, you already put all this effort in. This looks so amazing. Yeah, just keep going. Oh, if it did X, then yeah. Oh, definitely we'd use it. Bullshit. Just like completely untrue. Yeah. Like you really need to see like how they spend the money. I know it's so frustrating because oftentimes they won't tell you, but that's the real indicator is like getting to the cash right away. And I'll say, the four things I keep on, biffing the last one, but it's urgency, importance, budget, and then is the problem sufficiently challenging? Like, can they actually solve it themselves? Is it easy for them to do it by themselves? Or like, is it hard enough to warrant outsourcing? And that's like, those four things. I'm always looking for those in interviews, lots of open-ended questions. Oftentimes I'll just let them talk, and people only talk about what they care about, by the way. So like, if you just let them talk, they'll tell you what they care about,
Yeah, I love that. Thank you for that. Well, Brent, this was terrific. I think we did just what we said we probably wouldn't do, and we spent a little bit of time talking about this, but it was terrific. I really enjoyed it. Thanks for sharing your experience. For the website, somebody posted in David Busby. Do you know David?
No, I don't.
He did us the favor of posting the link to that calendar or that calculator. So good for that. Is there anything else you want to share just on your way out?
No, connect with me on LinkedIn. Like I said, I'm a relentless networker right now. So, please feel free to reach out. If anything I'm doing is interesting to you, give me a thumbs up. It helps with my distribution and further networking.
Terrific. All right. Well, thanks again, Brent. See you at poker.
Oh, that'd be great.
Yeah. All right. So that was terrific. Next, I'm going to bring up Nick Hughes. I've known Nick for a really, really long time, back when he wasn't a founder, and then he was a founder, and then he wasn't a founder, and now he's a founder again. Founder of Founders Live, now an international network of startup ecosystems around the world. And I live vicariously through some of his updates. He's been to some amazing places. He's in many senses living the dream. And I'm going to try in this conversation not to show my jealousy. But Nick, I'm going to bring you up, and I'm excited to learn, to have this conversation about some of the things you've learned over all your years, of talking with founders and seeing how this early part of the journey goes, especially with fundraising. But first, take a second and tell people who you are. You have this fascinating journey that you've been on from the really early days until now. Just walk people through the perspective you've had over all these years.
Yeah, well, thank you, Bob. It's just a pleasure to be here, and I love, me and you just work well together in terms of just chatting and sharing wisdom. Yeah, Nick Hughes. I am the founder and CEO of Founders Live. I want to save a lot of time to cover the things we want to cover, but a very, very short, quick is almost 10 years ago now, started an event in Seattle. It was a pitch competition. I tried something and magic happened that night, and it was awesome. And I just kept repeating it. And some of the things that were covered earlier in this conversation around just spending time in discovery and testing before you invest a ton of money or time, worked out really well. And so, long story short, put together a system, a brand, and an experience. And lo and behold, we're now in more than 100 cities across the world, and more than 40 countries, and it's on every continent. And I guess in the end, look, entrepreneurship is a human desire. It does not care in a sense what you look like or what nationality you are, because this is the way the world works. Entrepreneurship runs the world in terms of commerce and sustainability. And so what we've brought to the world has been pretty fascinating. Yes, I am in a number of different cities and countries over the years. We can talk about that, but I know we have some important things to cover.
We do. And I know it's different in different places in the world. So partly I'm interested too, because you have a perspective on entrepreneurship that I don't. I'm North America man. So, I have I think a fair grip on what happens here, but I know that things are different in other places. So I hope we get to touch on some of that too. So, the fundraising is this really interesting beast. And in some respects, partly based on what Brent just shared, it's really hard to get it right, to do it, how it's structured, and how you run a process, and the things, just the dynamics of how funding works. And there's nothing about being a first-time founder who's never raised venture capital before. There's nothing in most human beings' experience that prepares them for that teaches them how that works. So it's everybody's learning it as they go, shooting from the hip. And there's some fundamentals that I think are essential. And as we look in this current environment, super hard environment. I mean, you've been in this a while. I've been in this really long time. Yeah. This environment is as bad as I've ever seen it on a couple of different vectors. And part of the challenge is when are we going to come out of it? In past downturns, the few that there were, people kind of had a thesis about here's what caused it and here's what's going to come out of it. But there's never been a complex arrangement of causes and the things that have to happen to come out of it. So I'm curious right now, just as you see the market, you don't have to make any predictions, but if you want to, that's great. Mm-hmm. What got us here? What's going to get us out of here? And how do you know when we're going to come out of this?
Well, look, in terms of, I still speak from a founder and from founder's point of view. We, again, as you mentioned, we have startups and founders from all over the world. The whole entire world is a downturn. We were talking about this earlier a little bit, but just look, the numbers are 50 to maybe more % down from what they were a year or two ago. Let's understand that a couple of years ago was an anomaly. Things are probably going back to what would be a normal, in a sense of just knowing that, and what we want to do is kind of take it from a high level into what founders should really think about. But we are leaving a period of time that money was available and investment, from angels early stage to strong venture capital was just there. A lot of checks were being written. That's not happening anymore. And let's agree that that's gone. And so if that's the case, I'm going to at least say, I don't think we're ever going to get back to a point of what it was in like kind of the pandemic and coming out of the pandemic when there was just hundreds of billions of dollars invested. And so this now needs to come down into what I would like to do is at least touch on some thoughts and ideas around how founders should really look at the fundraising experience, how they should understand, some of the things that come up to me are like, look, if you do end up raising money, that's a treadmill that starts and increases in speed and can never be reversed. There's things that happen or decisions today that you make that will affect tomorrow's decisions that can't be reversed, right? So let's maybe just toss around some thoughts and ideas around how founders should think about, approach their business, their startup, as well as attempting or not to fundraise, knowing that I would just say you want to start with the end in mind, which is a sustainable business, right? And maybe it's not. Maybe it's like, hey, we're just going to shoot for the home run for 6 months or a year and then try another idea. But I don't think that that's great entrepreneurship. So it really understands, you need to understand what is the long view here? What's beginning and end in mind? And then how are you approaching financing options? But that is not, your business is not to please investors. Your business is to create, as we heard before, find a problem for customers, create a solution, and make that cash flow sustainable.
Yeah. So if this is the new normal, and for founders who started their journey in the last, call it, 4 or 5 years, it might have taken a year or two, and you get to the point where you're in the pandemic and you're raising, but your experience for many founders right now is that there is this land of plenty. So the fundamentals, though, weren't important over the last couple of years. Now the fundamentals are important again. So there's a bunch of fundamentals, but for you and the companies that you see, what are some of the fundamentals that you think get missed that are just so important? Like, you got to get this part right. Yeah, certainly, start from the end and work, build a good business. But tactically, what are the things that you should be thinking about if you're trying to raise money in this environment, which feels bad, right? But it's not dissimilar in volume than other times.
Yeah.
It's just that if you look at that volume, the number of those rounds that are being how many rounds are being raised? A lot of those rounds are distressed. They're flat, they're down, they're extensions, they're various things, right? So what are the fundamentals then for a founder who's raising, probably their first round, institutional round, but even angel round? Like, what are the things that you see most often that you wish founders understood about the fundamentals of fundraising?
Well, a few things I would say that pop up real quick are, understanding, your business economics in the sense of, what are the unit economics? What are the cost of customer acquisition? What is the lifetime value of that customer? Some of these things, right? This assumes, by the way, that you've built something, it's deployed into the market, it has market traction, if not actual product market fit. Those are default assumed before you would attempt to fundraise. And then having graphs that are going up and to the right. And I think, what you're saying, Bob, is, look, the hurdle or the barrier just got a lot higher, and it was kind of high before. And what does that mean? That means that, some of the notes that me and you were trading here as we were preparing of being 1 out of 100 and being a great startup is not even making it anymore. This is for fundraising, everyone. So I think part of my message, at least, is to just hope and pray that we're going to create something, have some developers, and go pitch 50 or 100 investors, and hopefully a couple say yes. I just don't see that is a great path to any quality of success for early stage startups. A better thought is heads down, for the value of creating a solution for customers that then has a pricing structure to it, and they pay for it. And by doing that, you're not only establishing your fundamentals of the business, but then you will be much more attractive to the investors that you're pitching. I'll toss it back to you, Bob. How does that resonate with you? And when you do listen to pitches, are you looking for those things, or what are you looking for? This is a kind of fun dynamic here, but this is what I would say, is that rather than spending your 100% effort trying to get that, hopefully pray for an investment, spend your time in the business and getting it off the ground and getting those metrics up and running. What do you think?
Yeah, well, I think that's absolutely. So what I've learned over the years, I didn't know this. My first couple starts, I had no idea, right? I was clueless. But a few dynamics of the venture capital world, you mentioned the treadmill. That's super important. You didn't really elaborate on that. But look, if you take other people's money, you're committing to something long term. It's not like, if we just had money now, then we could get to the next level. And then those investors who invested us then, like, they'll be happy because we're going to have a great company. But, funding comes in stages. And what you said makes me think about stages. Like, there's been somewhat apocryphal belief that, but it's really early. I'm supposed to just have an MVP. Super simple. I don't need customers. I don't need revenue. I don't need a production product. I just need a Figma that shows what this thing. Here's the. We need to raise money so we can build it. That the notion that investors are supposed to take back of the napkin risk in the earliest days. There are some that will. Institutional investors typically no. Angel investors sometimes, but lots and lots and lots of rounds get tried. Relatively few of them actually close any money. The place for, in my view, I got an MVP, I've got, here's our back of the napkin sort of idea stage thing, is friends and family. That's where it starts. And if you don't have friends or family who you can get that money from, you're in a hard spot. And I wish I could solve for that, but that's a super hard spot to be. You're going to have to probably build something that shows some traction. I like that you said, I forget how you put it, but up and to the right. The numbers don't have to be big, but you have to show that you're trying to actually build a business, not a project, not a cool thing, but a business. And businesses make money. There was this time a decade or so ago, I was really frustrated because I talked to so many founders who would talk about their startup, and all they want to talk about was the product. It was the product, it was the product, it was the product. And it was so cool, and there's nothing like it, and it's super awesome, and look at this button, it does this, and none of that really matters. Like when I talk to founders now, like almost the last thing that I need to know very much about is the product, right? The product, I think product risk in most startups, unless you're doing hard tech, edge tech, like product risk is really low. Stuff's cheap. There's lots of talent around to build it. If you have the capital, you could build it. I believe you. You're an experienced engineer, whatever. I think you could probably build a product. Question is, are you building the right product for the right customer in the right market, the right price, and right? Those are the things I care about first. So thinking about, like, as a founder, understanding that the hurdle is not, but it's a brilliant idea, and I've got this, that, or the other validation. Like, build stuff. Don't go heads down, do the customer development. Like, I can spot it a mile away. If you show me this big elaborate product that you've built and you've talked to 3 customers and you think you did customer discovery, like, oh my gosh, I don't know if you're going to be doomed, but that's where I'm going to put my bet, because that's how it almost always goes. So I'm not advocating for, just go build stuff. Like, first do the work that shows you understand the market and this customer and what they care about and how you're going to sell it, and be able to formulate what we call sort of having a cogent story about how this thing that you want to build could, in principle, in a cogent way, be successful. You can't do that. You can't tell a cogent story. Like, why do you want investors to invest in you if you can't? They need you to tell a cogent. That's what diligence is. Like, do these guys have a cogent story?
Let me just jump in there and even just point out that kind of like tying in some of these things we were saying, which is, look, I think it's just, trust me, it's better to be early with no funding raised and still figuring out product market fit than have raised a round probably too early, and then now at a place where you've spent all that money and you don't have target market fit, and now you have limited options. Okay, that's one thing that I think before we're done, we want to really crystal clear.
Yeah, absolutely. Yeah.
This is what the treadmill means. The treadmill means that the moment you take on a certain amount of funding, whether it's the angels, or as if you even get up the chain a little bit to actually a venture around, all the things that the terms, the covenants, the fact that there is possibly no second round, like in terms of no second attempt, because the company has taken on a certain amount of funding, or maybe there's debt there. You took some bridge rounds and there were convertible notes. These are what so many startups that raised in 2022, like 2021, 2022, and maybe earlier this year, are now hitting, and they're lacking the options to even move forward. So what I'm suggesting is at least begin with the end in mind and understand that, and keep your options open. You can continue if you want, but the moment you've raised money and now you're in a place where you're still trying to find the business is I would say a horrible place to be.
Yeah, I think it's really important for founders to know that when they raise money from an investor, the investor cares about like what you've done to get here, and they care that there's a story that this thing could be big and that you can get there. Lots and lots of investors, when they make an investment, part of the cogent story they need is that if I invest in this company now, they will be able to raise the next round. Because there's no, venture capital is not isolated to I make an investment and then we'll see how it goes. I make an investment, and then I want that investment to go up so I can effectively, it gets sold to the next investor and the next investor until, some eventual liquidity. If I don't have conviction that if I give you 500K now, that you're going to be able to raise 2 million in, 12 to 18 months or wherever your milestone is, like, it's hard to make that bet. Like, I love you. I love the product. I love the customer, problem. I love the market. I love so many things about this, but I can't get to the point where I think you will have the runway to get to your next round. And in the very earliest stages, pre-seed and seed, that's what goes wrong a lot. I invest and then they can't raise the next round. So, the things that you should know as a founder, how investors are thinking about investing in you. They're not necessarily investing in you because they love stuff about you and your business and the opportunity in the market. They got to love that. If they don't love that stuff, they're probably not going to invest. But they could love all of those things and genuinely love what you're working on. This is awesome. And then you'll often hear, we'd like to see X, whatever X is. And regrettably, a lot of founders, it's okay to take that as, oh, I've got some work to do. I got to get somewhere. But whether or not, that's usually not a commitment that says, when you get to that, then I'll invest. But lots of founders walk away from that conversation thinking that. So don't think that if you're a founder. That's not a commitment of any kind. It's just a way for an investor whose answer is no, I will not invest, to give you some guide, like some things to think about to hopefully make you better. Right? It's not that is the one problem that once we fix that, then we'll be able to raise. And, investors see, and nowadays with the virtualness, 1,000 deals or more a year, and they're going to invest in like 4 or 6 or something like that, right? So the percentile of deals that they're actually going to invest in, like if you don't look like to them, and this is like one of my biggest tips. If you can't tell me why the investor that you want to pitch will see you as a top decile company, which is a hard thing to do, top decile company for their investment thesis, their check size, their round size, the traction that they normally would invest in, the kinds of rounds that they normally invest in. If you can't tell a story about why that investor looks at you and says, wow, I got to know more about this top decile. I recognize the signals of that startup. I want to learn more, because they're going to see 1,000. They're going to cut and cut and cut, and they're looking for the ones that they should have a deeper conversation with. So knowing that, like the apocryphal again story about, I had to pitch 100 investors until I found somebody who got it right, and then I finally got my first check. Yes, that happens, but more often than not, the reason that happens is because you spent all those months, like pitch after pitch after pitch, getting feedback, repairing things that were broken, making things better, adjusting this, getting a little more traction, until finally you became fundable. It's not like I was fundable from pitch number 1, and I didn't get funded. It took me 100 times. Almost never. I'm not saying it doesn't happen. Could happen. Some things are hard to understand. It takes a very specific kind of investor, and you got to look a lot to find the kind that would really understand what you're doing. But mostly, it's because you spent 7 months, 90% of your time, not working on the business, and instead pitching and fixing the deck and pitching again and fixing the deck until you finally got to a place where the business got better, and then investors all of a sudden thought, well, actually, this is kind of interesting. So try not to do that.
Try not to do that, and let's illustrate taking forward what you just said, because in the end. And I want to be mindful of time. I'm loving this, so we can just keep going for a little bit longer. But understand that there's there's like essentially two paths here, right? And as founders, I would suggest, again, seeing thousands around the world and just seeing patterns and understanding, where success comes from, is you have to commit to a path. Do not straddle these two paths. The one path that Bob just described is the commit to 100 investor meetings. And what's amazing is I love how you actually described that, Bob, which is the change from meeting 1 to meeting 98 allowed for literally the shift in the really adjustments and iterations from the founding team, and the way that the pitch was structured and all that allowed for that funding to happen. Great. You raised 1.5 or 5 million or whatever. Amazing. And you did that, and now you are a funded company, and you also still have to execute on the business. The other path here is to not expend any of that energy and literally go build your business. You're taking all that time and energy, focusing it on the product, the customer, the team, your value proposition, your go-to-market, your sales, and you're going to start seeing those metrics go up. The great thing about that path is you are not only growing revenue, but you can become more attractive as a business as well. But my last point is, it would be a very big mistake for a startup to try to do both, because you don't do well here and you actually don't do well here. So look at those paths and make a commitment to where you want to be initially this next short period of time, 1 or 2 years, and go do that. That would be my main advice.
What I would add to that, because I do think most people who pitch 100 investors, they don't start out thinking, okay, here we go, I'm going to pitch 100 investors. They go, no, I'm going to go raise money, and they start talking to investors, and it's the frog in the slowly boiling pot of water. 7 months later, you wake up and you just had the 100th pitch, and maybe somebody's interested. But there are things that you could have known before, and I'm an advocate of deliberately setting a course based on the milestone. Venture capital, you can build a startup any way you want. Don't take other people's money. Do anything you want. Have fun. Like, knock yourself out. I wish you well. If you want to take investors' money, you should know how investors think. And one of the ways that lots of investors think is they think in terms of milestones. Like, if I give you my money now, here's $1 million. Like, what will you do with that money? That's why the use of proceeds is more than just like, oh, are you going to spend this money on vacations and cars? Or are you going to spend it on stuff for the business? The reason that matters is because they want to know when they're doing their diligence, like, can these guys really get there? Like, they say they want to build this big, here's the hockey stick. And if the milestone is just, well, if you want to know our milestone, you just look on the hockey stick, however many months out, that's our milestone. But I think milestones need to be different. I think you need to say, we're raising $1 million because $1 million will let us do these things in this way over this amount of time, with some level of detail that gives the investor confidence that when you say you're $400 a month in revenue, you're going to get to 10K. Like, that's a big jump, right? Can you really do that in 9 months? I don't know. The extraordinary claims require extraordinary evidence. So just show me the math. How would you do that? And that's where the diligence comes. Say, oh, so what channels, what tactics, right? What do you think your CAC's going to be? Why do you think that? All these assumptions underlie that milestone. So if you have in mind a milestone first, like, should you just pitch 100 investors? You just shouldn't. That's not a good. I hope nobody ever says, well, this is how fundraising works. You got to go pitch 100 investors. Don't do that. Instead, think about where you're at and where you can be in some period of time. And if you haven't raised before, I think 4 to 6 months is the right period. You should say, in 5 months on some day, like, we're going to get to 3K MRR, and I can convince someone who's smart, who knows our business, and can understand the assumptions we're making, that they would agree that we can get there too. And if they can't agree, then we're probably not going to get there. And you should just accept that it's not, your brilliance, your genius is not going to overcome quantifiable assumptions that have to happen over time. It's not going to happen. You should be able to say, here's what we're going to get one. Then if you want to raise, then that milestone should unlock something that allows you to raise. Because I can hear a lot of founders say, yeah, but it's one thing to say like, yeah, go build your product and get customers and get up into the right numbers, but I need money to do that. Well, it is true. Sometimes you need money, but you need to navigate. You need to figure out, how do I get from here to there with the resources that I have? And telling an investor like, and this isn't fair, but it does feel this way sometimes when I hear investors tell me, or I hear founders tell me, we've got this all laid out. We know exactly what's going to happen. If we just had the money, we could be great.
Yep.
If we only had money, we could be great. And then they spend 7 months telling investors over and over, if we only had money, then instead of saying, investors are not going to invest in us where we're at. We're not fundable by the kinds of investors that we think, right? But here's a milestone we can reach with the milestone with the resources we have, that we think those investors who we think would be our next investor, they would actually appreciate that. They would think that, oh, good, that's the place to be. And I see that it unlocks this next thing. And that next thing, if you're pre-seed or seed, that next thing you unlock with their money better be something that influences your next round of funding.
Yeah.
If it's just like, oh, yeah, but we need more features. We need to make it bigger and better. Like its product's not right. We just got to build product. Like, okay, that's dangerous.
Look, I would even add, is funding required outside of paying your salaries? As was mentioned before here, is funding required to start rolling out and getting growth in your business? And I'm just like, look, I've been doing this enough. You see the gray hair. All right. It is amazing to me where I'm like, oh, wow. So you just hear from these founders, they just think the only option is, okay, now I need to go pitch investors, or it's like fatal. And I think that from my view, let's take a different look at the business here and at the whole entire thing, what you're building. And if you can't hit, as you were mentioning there, Bob, like if they can't turn around and actually create enough in the phase they are now to get positive growth, whether that's user traction or revenue to start funding things, then if they can't do that without any investment, I would say it's not going to happen even with investment. So or say it differently,
yeah,
they're not going to get funded, right?
Yeah, that's a safer thing to say. But I will say too, this is that you started out talking about this. Like if you raise too much at too high a valuation, here's what happens. So you say, oh, we're really excited. We raised, it's our very first round of funding. We raised, we're pre-seed, we raised $4 million. We raised that at $15 million valuation. Like we're so proud of ourselves. We're amped. We're going to go get it. We're going to hire a bunch of people. We're going to build product. We're going to sell stuff. We're going to go. Sort of baked into that valuation math and the amount of money that you take is an expectation in the venture capital world that you're going to do something with that has a material impact on the value of the business for that next round in a short amount of time. So depending on how much you raised for what milestone it was, if you had, for example, 1 year milestone in mind, you're going to hit that milestone. That milestone will unlock the next round of funding. You'll start raising. You'll raise in 6 months. That gives you 18-month runway. Everybody thinks that's great. But what happens is you raise a bunch of money, then the expectation is you're going to hit a really big milestone. A milestone that you are probably, it's a stretch in the best of times with all the wind at your back that you could make that milestone. If you get that milestone, you double or triple the value of your company, you raise the next round, everybody's happy, you get another run at the next milestone. But if you don't hit that milestone, if you raise $1 million, right, on 3 million valuation, and you raised it for 9 months, and you could get to a milestone in 6 months that allowed you to raise over the next 3 or 4 months, like you're okay. You're gonna get there. You might be able to raise your next round. Same product, market, all that stuff could be the same, but you raise 4 million instead of 1 million. So now the milestone you have to reach in 18 months is huge, because if you raise it at 15, imagine where you have to be in 12 months to justify a $30 million valuation. Like where would you have to be? Like you'd have to have the ungodly metrics that go so sharply up and to the right that those next investors are like, oh, this is going to be one of the big ones. Yeah, we're in. That's why you see so many down rounds, flat rounds, extensions, and whatnot, because people raised so much money. It was so easy to get over the last couple of years that the milestone they would have to reach in order to look good, even look good in good times, let alone look good in bad times, was so high that they couldn't reach it. And so now they're stuck. And lots and lots and lots of companies right now are going out of business because they can't raise that next round because they raised too much, or even if they raised a little bit, maybe they raised the right amount, but they were, they were really happy because they got great terms. It feels like great terms. We raised, $1 million on 10, right? Or 500K on 5. That feels great. Okay, maybe, but what'd you do with that money? And are you ready now to get that next valuation at 10, 20, $30 million? And if you can't do that, those investors, then they don't care about the cut of your jib. They're like, oh, I love this product market. I've been thinking about this for long. I'm glad somebody's going to solve this problem. This is awesome. Like, the earlier in the capital cycle you are, the more forgiving the investors are in terms of metrics and growth and things, because they know that's what's coming. You're funding them. You're funding the founders to get there. But once you raise that first round, now you're getting your next one. I don't care about how gorgeous your hair is. Like, I need to see the metrics, because I see 1,000 deals this year. And even if you're good, you alluded to this before, Nick. Like, when I see a deal, almost any investor, active investor sees deals, they don't see you in isolation. Oh, Nick's got this really great company. They got revenue. It's up and to the right. The numbers aren't big, but I can see the growth. And this, I like all these things about it. I'm also evaluating 10 or 15 other companies at the same time. So you don't have to just be a good investment. You have to be the best investment I'm looking at the time. And right now, there's so many startups kind of on sale, right? Because of the conditions, there's a lot of flat and down rounds, recapitalizations, things that are happening that create opportunities for investors that make it even harder for you as a quote good startup to get money. It's super, super hard.
Yeah. And the summary of that in my view is, and again, sometimes I'm a simple guy, Bob. I think I try to dumb things down so I can just make decisions. But it's like, look, if the percentage chance of success, I'm just saying, like, to get what you need to move forward, if you're going and pitching investors to raise money is a certain percentage, probably pretty small. If, as you suggested, they're just seeing so many deals and it just has to be the right deal, versus the percentage chance of success if you actually go towards your customers, build business, grow revenue, and work damn hard at that. 100% success over here if you pay, if you do the right things, because you're building your business. Now, it's going to come in smaller chunks, and you may or may not be able to hire 5, 10, 20, 50 people. That's the reality. But if you look at that, where is your best chance of success for this phase? That's all we're talking about here. Yeah. And so, the way I view it is, rather than playing this lucky card thing over here, and again, I'm simplifying it, but if what we're doing here is we're creating value, we're creating business, and we're growing something, focus on the things that you need to do so you can get those graphs that are meaningful, those KPIs in your business to start growing. Mm-hmm. Well, seriously, the best thing to do.
So, and I want to dissuade founders who think like, yeah, but to do that, I need money because I got to build a product, I got to do marketing and sales, all this stuff costs money. I got to hire people, blah, blah, blah. That's all true. But they're assuming that the numbers that an investor needs to see are these big numbers, like on their hockey stick numbers, and they're not. Like, I love it when I see an early company that, they went from $300 MRR to $800 to $1,200 to $3,000. And they're just focused on like, yeah, but we want to understand our customer. We want to make sure we're building a product people use. We don't have a lot of money for advertising, whatever it is, but they're just continually, the numbers in themselves are not big, but the trend is beautiful. It's like, oh, you're actually trying to build a business. You're not trying to build a product. You're not trying to build cool shit. You're trying to actually build a business. Yes. And it comes through if what you're focused on. Don't worry if the numbers are small. I don't care if the numbers are small. Just, start where you can. Do the best you can to make them go up every single month. Whatever, go sell another customer, go sell another customer, go sell another customer. That is so much more valuable time spent than pitch investor, pitch investor, pitch investor. Because the things that they care about the most, usually, not there's exceptions to every rule, but in general, the strategy to like take wherever you're at and just go raise money, as opposed to, wait a second, take a step back. What can you do to show that you're building the business? You can go meet investors. Don't pitch. Like there's a great aphorism from I think it's from Techstars. If you want money, ask for help. If you want help, ask for money. Go talk to investors in your space. Hey, we're not raising right now, but I want to get your feedback. Like, what about this? What do you know about that market? Like, where would we have to be, before we'd even approach you? Or, it's okay to talk to investors, but if you're pitching them and you're not ready for their thesis, and that's why when I see a spreadsheet, a founder has, oh, you got some investors, who are you going to pitch? Like 200 investors on a spreadsheet. I'm like, really? There's 200 right fit investors for you. That's remarkable. And as you go through, you say, well, no, it's an investor, it's an investor, it's an investor. They didn't look at the portfolio. They didn't look what check sizes they write. They didn't look at the kinds of rounds that they didn't look if they lead or not. Didn't look at, the sectors that they've invested in before. And it's true. Like, some founders say, always be pitching. Always be willing to share what you're working with anybody who will listen. But if you're fundraising, you run it as a process. You have leads. You're looking for investors that in principle look like the kinds of investors that will see you as a top decile. If they've never invested in your sector before, they've never invested in your stage before, they've never invested in a round like yours before, if they're on your list, take them off. Don't waste your time and don't waste your mental energy like thinking about all these. Like, find the ones who you can tell a cogent story about why you should pitch them, because they're going to get it, right? And it opens up so many other possibilities. Once you have that list, then you can triangulate on those folks in various ways, and you'll get better introductions, and it just makes more sense. And then spend those 7 months not pitching, spend those 7 months moving it up and to the right until you look like the kind of company that would be investable by that kind of investor.
That's so good.
Not to simplify it, right? I mean, it's this all,
right.
One size doesn't fit all, and it's not as simple as all this, but there are some fundamentals that if you get these right, you'll have less friction, you'll have a better founder life.
Yeah. And look, it doesn't mean that, I don't think funding is a good idea or great. I mean, I do in certain specific scenario, but I think it needs to be evaluated and it needs to be understood, the process. And the last thing I would say is, look, and founder's life is not perfect at all, but, I think it's a good example of this happens all over the world. I built something, we built something all over the world, and we did not sit here and try to raise all this money. We just figured it out. So you all can do the same thing, like you in your own way. There is a way to get traction and growth, regardless if you raise money or not. And then when you get there, you'll be the hot girl or guy at the dance. That's the way to look at it.
It's really rare. I mean, I'm trying to think of an example. I can't think of one now, but I suppose in biotech, med device, certain kinds of hardware, like that really hard deep tech stuff. Sometimes you can't really do it because it takes 4 years to build a product, right? And you can't do it without any money. There's different styles of companies that require different kinds of funding strategies, but it's really, really rare to find a company that builds software that's anything like software-ish that can't make the right kind of material early progress without raising money. And the most common one is, but what you've built so far, isn't there a customer that would pay for that right now? I know it's not what you want. You want to build it out. It's got to have this. It's got to have that. Yeah, but what if you just cut it off, trim it up around the edges, and go find the customers who can buy that right now? They say, oh, thank you. You're solving my problem. Won't be as much money, right? But you can still get it in customers' hands, start to get actual revenue, small, but it'll grow. You learn so much by doing that. That's beyond just, am I going to look good to investors? Like the moment of real committed customers paying you for that, once it gets in their hands, not only do you exercise all those muscles of support and actually taking a payment and fixing bugs that get found and all those things, you also now have a reference client that you can point somebody else who's using it, right? The conversations that you have with investors will change dramatically. You become a not pre-product company, right? You become, you're not really not pre-revenue, right? Because small revenue that it doesn't count as I'm a post-revenue company, but it shows a certain deliberate intention to build a company as opposed to build a product, build cool shit. And you learn so much. That feedback they're going to get, you have this product roadmap. Oh, we're going to build this now, and then we're going to build this. You know what you're going to build for the next 2 years. And then you get it in the hands of a customer, and they go, actually, that's not what's important to us. This is. Oh my God, they'll pay for that now? And all of our other customers say the same thing. Let's do that instead, right? So super, super important. The numbers don't have to be big. Get in customers' hands. Get them, using it first, paying for it, hopefully. Like don't spend too much time like, oh, it's a free pilot because we're early and right, it's not perfect. Like for a minute, do that for a minute. But you should be building something that is valuable at the soonest possible time. You shouldn't have to build a full Taj Mahal in order for it to be valuable. And if you keep putting off, will customers pay for it? Will customers pay for it? Like it's better for you if you just find the value, triangulate on what's the earliest value we can provide to a customer and get them to pay for it early. That's better.
Well said. Bob, this has been great. It's been great to be here. I appreciate, the invite to join. And I just want to shout out Stephanie, if she's still in. She's excited to pitch at Founders Live in November. So there you go. Good luck, Stephanie.
Fantastic. Super, super smart founder. I'm excited to see her pitching at Founders Live. So yeah, thank you, Nick, so much for sharing your experience and wisdom and perspective. Thinking back, remember that time you interviewed me on your podcast?
I did, and it was like in a brick. It actually, if you search Founders Raw, you might discover some things on YouTube. And it was in like this really cool place down in Pioneer Square in Seattle, and there was a brick background. And man, that was like 10 plus years ago.
Yeah, that was so much fun. I still think about it from time to time. And if I ever see somebody will point out, I go, oh yeah, it was so good. And to see the trajectory that you've taken and the massive impact that you're having for founders all over the world, kudos, man.
Thank you. Appreciate that.
All right. Well, take care. So everybody else, I think pretty much everybody here is a member. If you're not a member, if somehow you snuck in, and you are a full-time venture scale founder or active investor who invests in venture scale companies, check out startuphaven.com and apply for membership. All right. Thanks, you guys. Take care. And we'll cut it there. Thank you so much, Nick. Appreciate it.
You're welcome. It was great. I'll see you soon, Bob.
All right. Cheers.